And in 1983, he bought a property in DeSoto, a town just south of Dallas, 223-acre tract for $5.3 million. A year later, he set up a partnership with a guy from Holland, and he sold the property to himself and the partner for $10 million. A year after that, that partnership sold the property back to another Reese company. He sold it back to himself for $15 million.
Now, what's the point of this? I'm not sure I understand the financial benefit accrued from doing this land flipping.
Well, he would borrow the money from a bank to sell the property from himself to himself.
So he would take the profit himself?
Exactly.
Okay.
Okay, and the way he would do it is he'd get an appraiser to appraise the land at a higher value each time. That's all. And this was called land flipping, and it was very common. In fact, one developer told the story of being in a courthouse, a county courthouse near Dallas, one afternoon, and a very real prime piece of property was up for sale. And what they did was they lined a hallway in front of the county clerk's office with card tables. Ever hear this story?
No.
This is incredible. With card tables, okay? So the deed comes and sits on the first card table. Here's the buyer, here's the seller. They sign everything, pass papers, all the checks. But then they pass the deed to the next card table. New buyer.
Same property.
Same property.
Right.
And they'd pass it down this line.
And it would go up every time.
Each time the value would rise. Okay.
Now where was the money? Where was the money coming in to do this? I mean, wasn't there?
Yeah, that's right. Each buyer
had to borrow.
Had it borrowed from a savings and loan.
So this is what increases the debt. Right. So every time they do this, they put in their pocket the profit, but they increase the debt.
That's exactly
by
right.
borrowing from the S&Ls or whoever to finance these actions.
That's
so the debt grows, it doubles every time they double the price.
That's right.
Of this thing. So this is how the debt doubles and skyrockets.
That's exactly right. That's how all of these inflated values took place. Now, each borrower would have its own appraisal, and it would have its own idea for the property. Okay, so if we're going to build a Taj Mahal, somebody might want to paint it. Somebody else might want to put mosaics this big. Well, that's going to cost you more. Okay. So, all of this development was like the figment of people's imagination. Now, at the same time, in the early 80s, Congress passed a law that said that savings and loans could use new accounting procedures. Here's another change in an associated industry. The accountants, the way it worked was, let's say you had a piece of property and you sold it and there was a $20,000 loss. Just for fun. It never happened in those days. But,
yeah.
But let's say there was a $20,000 loss.
It's happening today.
Exactly. Well, in the old days, before these new accounting procedures were put in, you had to say minus 20,000 and subtract it out of what of your net worth. Well, these new accounting changes allowed you to spread that loss over 20 years. So you could divide it. So you lose 20,000, you spread it over 20 years, you subtract $1,000 each year. So even though you took the hit in 1983, for example, it never showed up on the books. So it was
like deferring the taxes, it's deferring the losses.
Exactly. And so the books looked great. I mean, you lose $1,000, so what?
God, the whole thing's a fairy tale then.
Exactly.
So it's like fantasy finance.
The whole
fictive capital.
Exactly. The whole thing was made up. Okay. It was a daydream. It's now our nightmare, but it was a daydream then. Now, at the same time, remember, and by the way, the accountants were also following the same pattern as the appraisers. The accountants were supposed to be independent auditors that went in and looked at the books. Okay, but remember, they weren't being paid a fortune to do it. And so, I mean, one of the prime examples, for example, is Keating. His parent company was called ACC, American Continental. He went to Arthur Young in 1986. Yeah. And now they were making about $20 million a year gross. Keating goes to him and says, I've got a $3 million account here. and I want you guys to cooperate. Well, naturally, they're going to cooperate.
They're going to do what he tells them to do.
Exactly, exactly. And of course, 2 years later, the guy who was in charge of that account suddenly left his job at Arthur Young and took a job with Keating for $1 million a year. I mean, you know.
Joining all of Keating's siblings who were getting over $1 million a year for salaries.
Exactly. So, now, the other factor was the bank board itself. Now, the way the savings and loan industry was arranged was the federal overseer of all of the savings and loans was called the Federal Home Loan Bank Board. They had an office in Washington, and then they had 12 regional offices. And they had a dual function. They were there to support the savings and loan industry. For example, each of the 12 offices had a bank, a regional bank. And they would lend savings and loans in their jurisdiction money if they needed it. They would support them in various ways. And they would promote them. They would help with advertising and all kinds of stuff. But at the same time, they were the regulators. So, I mean, they had this dual schizophrenic role to play. And for most of the time the savings and loans existed, the first 40 years there was no problem because they were mom and pop industry. Everybody was pretty honest. Nobody was making a killing anyway. But when these other changes started to take place and things started to explode, nobody changed the regulatory structure. So there was this intense coziness, okay, between the regulators, the examiners, and the banks themselves. Let me give you an example. Right here at the University of Texas at Austin, there's a gentleman whose name is Robert Metlin. Now, Metlin is an expert in the world of thrift finance. Okay, that's his field, and apparently he's quite good at it. From 1983 to 1985, he sat on the board of directors of Lamar Savings.
The biggest S&L in town.
Right, exactly. Also the biggest bailout in town.
But that's held our alternative views account, as well as my house.
Well, you'll be very interested in this. So, Metlin was on the board of directors of Lamar Savings. He was also on the board of directors of Lamar Financial Corporation, which was the holding company that owned Lamar Savings. He was also, at the very same time, from 1982 to 1987, the head of the regional bank board.
How neat.
So he was the head bank examiner responsible for Lamar Savings.
At the same time, he was on their board and
at both boards.
Both boards, and
in 1984, he was named the Lamar Savings Centennial Professor of Savings and Loan Finance at the University of Texas.
Which means, is that an endowed chair? Yes. Which means he gets a hell of a lot of money for teaching over and above what professors normally get.
Exactly, and that, of course that endowment came from Lamar Savings.
Right.
And at the same time,
circle here, huh?
Oh, well, it gets better. He was also on the Austin Chamber of Commerce, which was, of course, regulating or promoting all this growth. Mm-hmm. And he was the University of Texas Vice President for Development.
That was also promoting growth and development.
Exactly. Mm-hmm. So,
with certain savings and loans and corporate finance.
Need we say more? I mean, you know, cozy, I guess, is hardly conveys the kind of conflict
incestuous
we're talking about.
Well, it's just the typical inside game of most regulatory agencies and their clients.
Exactly.
But
this is just a little more egregious.
There is a difference here, though. I think the philosophical underpinnings of all this is the Reaganite philosophy of deregulation. Let the market solve all the problems, be it banking or development or savings and loan or whatever. So this is really the major example of Reagan's deregulation running amok pretty early on. Early on, the Garde Saint-Germain was touted as the triumph of the Reagan Revolution, of the deregulatory policies being extended to the whole realm of finance.
Well, that's true, but you say the realm of finance, and remember, one of the key, the underpinnings of finance is the notion of risk. And there was no free market here. There was no free market at all because all of that money
was guaranteed.
Right. So it was a joke.
Right.
It was a myth.
So it was socialism for the gamblers, and the market for the players.
Well, it was just counterfeit. They were just legal counterfeiters, without restraint. So what was happening here is that the government was opening all the doors. Come in, let them by the hand, open the cookie jar, and say, hey, we're going to leave here now, and you folks can have fun.
Don't you dare touch that cookie jar. You know, I mean,
if you screw up and spoil all the cookies, we'll give you another
We'll give you more cookies.
Yeah, exactly. We got plenty in the back. So, you know, what really happened was, at the same time, of course, all the thrifts are pulling in deposits from all over the country. The insured deposits at $100,000. These $100,000 CDs, brokered deposits from all over. So the money's pouring in. The thrifts are pouring it out. Okay, they're paying developers who are overcharging them, who are paying architects, appraisers who are overcharging, who are contractors who are overcharging. Everybody's skimming. Everybody's taking their little piece of the action. Okay, so the boom is well underway. Everything's going fine. Now, they got to pay high interest rates on these deposits to attract them, and that's taken a big cut. What's probably taken a bigger cut is the lifestyle. I mean, they built these office towers. They had to buy planes because they had to fly over these tracts of land to look at them, and they're doing deals all over the country now.
Limousines to take them to the airport.
Well, exactly. They had all of these...
Call girls to entertain their clients.
Exactly. Promotional parties. Ed McBurney spent $1 million on 3 parties. You know, 6% loan origination fees. You know, you're bringing in a lot of bucks. You get used to driving a Mercedes. You get tired of the Mercedes, you buy yourself a Lamborghini, and so forth.
Well, this doesn't sound like mom and pop anymore,
exactly.
Who used to own the S&Ls. What we do is this whole new stratum of scumbags and charlatans move into the S&L industry and take it over.
In fact, there was a big split in the industry that took place during this. Several of the old-timers who had owned savings and loans for years refused to play. And they just kept doing the same thing they'd been doing. They were laughed at by the high flyers, who said, man, everybody's making a killing, let's go. But they refused. And in fact, there was almost like a little secession. There was a secession, in a sense, from the U.S. League of Saving Institutions, which was the main organization, national organization. Several of these more conservative thrifts dropped out. And in fact, there are about 1,500 healthy thrifts left in the country. Most of them are those that...
didn't play the game.
Exactly, stayed conservative. So there might be a lesson there somewhere. Now, we got the boom going, and then all of a sudden, a bunch of forces began to converge. As we've said, these high interest rates they were paying, the high-flying living, high cost of living. In 1985, oil prices dropped. Been up to $30 a barrel, suddenly dropped to 11. Okay. So, right away, several of the developers and investors who were putting together these enormous projects that the savings and loans were funding defaulted. Okay. Now, that started the slide.
This is around 86?
This is 85.
86? 85. Okay.
Okay.